So trading is not always about the chart, right? Trading is not always about the technical analysis. In this very video, I'm going to be teaching you guys how to set a Forex Risk Management Plan. So this is going to be a solid plan that's going to help you end every single trading week in profit. If it was a bad week for the market, maybe the chart was not so clear, you were analyzing, it was not going well for you, right? You're still going to end that week in a little profit or in break even, right? So it's going to help you avoid blowing your account over and over again. Now, every trader's dream is to fund an account, right? Grow the account, trade the account, and start placing withdrawals on that very account. Same thing on prop firm, right? You go to a prop firm so you can pass the phase 1, phase 2, and start receiving payouts, right? Start receiving withdrawal. And in this very video, I'm going to give you 5 solid risk management plan on how you're going to do that. You're going to avoid bruising your prop firm account and losing your account every single time. So it's going to help you end every single week in profit, like I always do. I always end every single week in profit. So I'm not going to waste time, right? Let me go straight up to the board and then show you guys how I go about it every single time. Now, the very first step in setting a Forex Risk Management Plan is your position sizing. Now, what this is your risk per trade. With this very risk management plan I'm going to teach you, we're going to try it on a virtual account, right? We're going to try it on a $1,000 trading account. Now, this might not be your normal funding. You might be able to fund, let's say, $10, $100, $1,000, $10,000, right? So this is going to be something you can repeat on any of the accounts. Even on your prop firm is something you can as well repeat. Now, the very first step to creating a risk management plan is going to be your position sizing. What this says is, on every single trade that you take, right, how much do you plan on losing if that trade goes against you? Meaning, if you do the analysis, right, you take that very trade, you enter the trade on your trading account, right? If that trade goes against you, what are you going to lose, right? How much are you going to lose? Which is this very first thing, right? It's going to be your risk per trade, right? Now, in picking your risk per trade, in picking a risk, maybe 1%, 10%, 5% of your account, right? In picking how much you'll be risking per trade, this is how you go about it, right? I have about 2 steps on how to go about it, right? The very first step is going to be a risk you can take, right? It's going to be a risk you can take. Meaning, if you lose this very amount on this very account, are you going to feel terrible, right? You personally might be able to fund $1,000, or you might not be able to lose $500 on a single trade. Meaning you've lost half of the account. You might not be able to lose it, right? It might be going against you and you start jumping out because $500 is a risk that is more than what you're comfortable taking, right? So you want to reduce it and reduce it to maybe 10% of the account, maybe $100. $100 is what you're comfortable losing. Maybe $50 is what you're comfortable losing. That's 5% of the account. So you want to pick a risk you can take. A risk once you lose this amount, though you're still going to feel terrible, you're still going to feel bad, but you won't feel so terrible, right? You won't revenge that trade. You won't jump out because the trade is going against you, right? It might be 5% of the account, 10% of the account. So it's going to be first thing, a risk you are willing and you are comfortable taking on that very account. Then the second thing is going to be how many trades before you blow the account, right? It's going to be how many trades before you lose the account. Now, if I go over pick and then say, I'll be risking 10% per trade. For every single trade I take, I'll risk 10%, meaning from this $1,000 now, I won't lose anything more than $100 on a single trade. Now, with this, I'm going to need 10 trades. After 10 stop loss, that's when I'll blow this account. Unless I lose 10 trades, I won't blow this account. Why? Because I'm risking 10% on a single trade, right? So these are 2 things you want to consider in picking your percentage risk. So once you consider the first thing, okay, I'm comfortable losing $100 on this $1,000. Or if it's your $10,000, I'm comfortable losing $500, which is about 5% of the account. Now you want to pick, okay, I'll be risking $500 on a single trade. If it's on a prop firm, right? On prop firm, I do go for about at least 0.8% to 1% risk per trade, right? Not playing it safe, right? If you want to play it safe, maybe 0.5%. On prop firm is a different case. But on your personal account, these are 2 things you want to consider. How many trades before you eventually lose that your account, before you eventually blow that your account? And also, is that a risk you're comfortable taking? If 10% is a risk you're comfortable taking on your account, then you can go for 10%. Meaning, after 10 trades, your account is gone. Right? You've accepted that, and now that's the first thing. Right? Once you pick your risk per trade, now the second thing you want to learn right here is how to now know, okay, I'm picking 10% risk per trade. How to now know on this very trade I'm actually risking 10% of this my account, right? I won't go over lose this very trade and end up losing more than what I plan on risking. So this is how you go about it, which is now you calculating your position, right? You calculating your position size on how much you are risking on the trade and how much you're going to potentially lose if that trade goes against you. Right? So there are two ways on how I go about it, right? In calculating and then knowing if this trade goes against me, I'm going to lose a certain amount, right? The very first way, or there are two things you want to know, right? The very first thing you want to know is going to be how many pips stop loss. Meaning on that very trade, how many pips are you risking? Now, in knowing how many pips you are risking on the trade, right? Let me share my screen right now and then show you. In knowing how many pips you are risking, we do use our trading view. You know how many pips you are risking on the trade, we do use our trading view, which is going to help you just know, okay, I'm risking 50 pips, I'm risking 100 pips on this very trade. And now once you know how many pips you are risking on a single trade, you're able to now calculate and then know how much you're going to potentially lose on that very trade. Now, in knowing how many pips you are risking, let me go over show you. Now, on major currency like your Euro USD, GBP USD, is just simple. Once you go over place your long or short position tool, you want to take a buy or you want to take a sell, right? It's gonna be like this, right? This number right here, this one showing about 21, right? This number at the middle right here showing 21. That's your risk on this very trade, right? This number right here showing 21, 21.0. So this is your number of pips. So on this very trade, I'm risking about 21 pips. Now my take profit is about 48.8 pips. This number right here is your number of pips. Then this, the same way you calculate it on gold, right? But on gold is a little bit different, right? On gold, that same number is your number of pips. So if I'm taking a buy or taking a sell on gold, I want to place my long or short position tool. So once I place it, it's gonna show me how many pips I'm risking. So on gold, because of the value of gold is a little bit high, right? Because of the value on gold, these are about 963 pips. But because of the value on gold, we remove the last number. So once we remove this last number, this is now about 96 pips. So on this very trade now, I'm risking 96 pips as my stop loss to make about 234 pips. So on gold, we remove the last number right here in knowing how many pips we are risking. So that's the very first thing you want to know, right? Once you now know, okay, how many pips am I risking on this very trade? You want to now check, which is the second thing. You want to now check which lot size is suitable, right? Because each lot size now have a certain amount you're gonna make or lose per pip. So the second thing, you want to now know which lot size is suitable. Now, for every single lot size in trading, right? I believe you know what lot size is. The lowest, the smallest, which is a mini lot, is a 0.01 lot size, right? And this 0.01 lot size now is equal to about 10 cents, about $0.1 per pip, right? Per 1 pip. That's the movement of this very lot size. Then the other lot size, 0.1 lot size, this one now is equal to about $1 per pip, right? It's going to be $1 per pip movement. Then we have the one lot size, and this one lot size now is about $10 per pip. So for every single pip that moves, either move in profit or move in loss, you're gonna be making or losing this $10 per pip. Then we have 10 lot size. 10 lot size now is gonna be about $100 per pip, just like that, right? Now from 0.01 lot size, we have 0.02. 0.02 lot size now will now be about $0.2 per pip. Just like that. That's how it keeps going. Now, once you're able to know this, once you're able to now know, okay, If I use 0.01 lot size, I'm going to be losing a certain amount per pip. Then, how many pips am I risking on the trade? And with that very trade, the first trade, we're risking about 21 pips, right? If you're risking 21 pips now as your stop loss, which you now know the first thing. You now know how many pips your stop loss is. Now, the next thing you want to check which lot size is suitable for your risk. Now, if I plan on risking 10% of this $1,000, that's about $100. Meaning, my plan is to risk $100 on a single trade and nothing more than $100 on a single trade. And this trade is about 21 pips stop loss. If I go over use one lot size, now, that's about $10 per pip. Right? One lot size is about $10 per pip. So this is gonna give me about 21 pips times the $10 per pip. Right? That's gonna be about $210. Right? So if I go over use one lot size, it's gonna be $10 per pip. So what you do is very simple, right? You go over multiply these pips, which is about $10 per pip times your 20 pip stop loss, right? It's gonna give you about $210 risk. So on this very trade, if I use one lot size, automatically I'm gonna lose $210 if that trade goes against me, right? It's more than what I plan on risking. My plan is to risk $100, which is 10% of my account per trade, right? I won't be using one lot size in that very case, right? What am I gonna do? I'm gonna reduce my lot size to maybe 0 points, maybe half of it, 0.5 lot size. And 0.5 lot size now is gonna be equal to about $0.5 per pip. Right? $0.5 per pip now times this, your 21 pips, that's gonna give you a risk of about $105 risk. With this, I'm now risking $105. It must not be the exact $100, right? It can be from $90 to $110, just within that region, and you want to make sure it's exactly the 10% or the 5% or the 1% or the 30% you plan on risking on that very account. Now with this, I now know, okay, I'm not meant to use one lot size if I'm risking 21 pips, but I'm meant to use about 0.5 lot size. And how do you know? You want to know first how many pips you are risking on that very trade, which I believe you now know how to know. Then the second thing is going to be which lot size is going to now be suitable for that very risk. And with this, you are now able to size your position and then know how to calculate your risk, right? So if I plan on risking 10% now, I believe you now know how to take a trade and then know that I'm actually risking 10% on that very trade, right? Now, just like that, that's the first thing with this risk management. So after this lesson, after this very video, I believe you can now go over, know what you are risking per trade, right? You won't go over, take a trade, you plan on risking $100, but if that trade hits your stop loss, you won't be losing more because you now know how to calculate your risk per trade. Right, I'm not going to waste time with just one thing. Like the second thing with this risk management, right, is your risk to reward ratio. Now, this risk to reward ratio is extremely important because it's what's going to make you money. With the first thing I just taught you, with the first thing I just gave you, you now pick, okay, I'll be risking 10% per trade, which is 10% is about $100 per trade. That's what you plan on risking on a single trade, right? Meaning if a trade goes against you, you won't lose more than that. And with what I've given you the first section, right, I believe you can now go over and make sure that you won't lose more than $100 or that 10% or that 5% of your account, right? Now the second thing is your risk to reward ratio. Once you are risking this 10%, how much are you gonna make if a trade goes in your favor? Right? If a trade goes and then you hit take profit, you make money. But how much are you gonna make on that very trade? That's what your risk to reward ratio is. It's what it's gonna be, what you are risking to what your expected profit is. And I do say have a certain risk to reward ratio. If you will be targeting 1:2, stick to it, keep targeting 1:2. 1:2 is this, right? Meaning you are risking 10% of the account, which is about $100. And if any trade goes in your favor, you should make at least $200 profit. Meaning you're gonna risk 1 to make 2. That's what 1:2 risk to reward ratio is. And it's gonna be the lowest you should ever go for, right? Don't go for 1:1, 1:0.1. You are risking $100, you are saying $50 profit, you are jumping out. right? It's not gonna make you money that way. I'm gonna show you how to go about it, right? How you're gonna make money with this, right? And or you go over risk $100, you are seeing $100 profit, you are jumping out, right? It should be at least $200. And my students, I have a mentorship class where I teach, right? My students, I do tell them go for at least 1:3 because that's what the strategy I told them is all about, right? The strategy gives a good risk to reward ratio. So they should go for at least 1:3 of whatever they're risking. Meaning if they hit any take profit, it's gonna be at least $300 profit, right? And nothing less than that. Now, with this, you're gonna be able to make so much money and end every single trading week in profit. Now, how is that possible? Once you go over risk $100 on a single trade, and let's say that very week you had 5 opportunity, right? Market gave you 5 setups, right? You have 5 trades, and out of that 5 trades, 3 went against you, right? 3 hit your stop loss, right? 3 SL. If 3 trades hit your stop loss, automatically you are risking $100 on a single trade. It's gonna be a $300 risk, so it's gonna be minus $300 loss. And if only 2 went in your favor, only 2 hit take profit, meaning the first trade you had 2 take profit in a week, right? Now you have 5 opportunity, you hit 3 stop loss, and you have 2 take profit. Remember, you're targeting at least 1:3, right? It's gonna be the lowest risk to reward ratio. I do teach with my strategy, it's always gonna be possible, right? It should be at least 1:3. But depending on the strategy you trade, maybe you trade the different strategy, you trade other strategy, you can go for 1:2, right? It's also a pretty manageable risk to reward ratio. It should be at least times 2 of whatever you are risking. Now, if your target 1:3, like I said, it's gonna be 2 of those profits, right? If you hit take profit, it's gonna be $300. If you hit another take profit, it's gonna be another $300. That's gonna be plus $600 profit. Now, if you watch what I'm doing here closely, you're gonna see you lost 3 trades, you lost about $300. Only 1 take profit now has covered for 3 losses, right? And if you watch on your $1,000 or on your $10,000 or on your $100 account, you're risking 10%. What is this gonna do for you? Losing $300 and making $600 profit is gonna end you with a week in about $1,300. Meaning that very week now, you ended it with about $300 profit. It was a bad week, right? You didn't win most of the trade you took. You only won 2 out of the 5 trades you took. But you still ended making that week, making $300, which is about 30% of that very account. That's very trading week. Now, if it was a better week, maybe you won 3 and you lost just 2, right? It will be a much better profit, right? You'll make more profit that very week. If you go back take more trades, you're gonna make more money. If you win more trades, and if you go back target a much better risk to reward ratio, if you're targeting 1:3, 1:4, 1:5, you're gonna make more money as well, right? But with this is how risk to reward ratio is gonna help you make consistent profits every single time. Now, I'm not gonna waste time on anyone, but let's move on to the next one. So I believe you now see the power of risk to reward ratio, right? Is what is always making me end every single week in profits, because me personally, I target at least 1:4, right? Whatever I'm risking, I'm gonna make times 4 of it if I need to hit take profit. So even if I go over, take 5 trades, I take 5 trades and I hit 4 stop loss, only 1 take profit is gonna cover for all the losses, right? So it's always gonna make you end the week in profit, but you won't end the week in profit if you fail to apply these other 3 things. Now, the third thing in setting a risk management plan is your loss limit, right? Loss limit is gonna be your daily loss or your weekly loss. It's gonna be your daily or weekly loss. Now, there are traders who are gonna do this, right? Once they hit 1 stop loss a day, they are done for that day. They will no longer trade again that very day. Now, me personally, I do go for 2. If I hit 2 stop loss in a single day, I'm done for that day. I will no longer take any trade again that very day. Now, how is this gonna help you? It's gonna help you avoid bruising your account every single time. A day, I've programmed that if I lose 2 trades, I'm done for that day. Meaning, I've already programmed it that I'm gonna lose 20% of that very account in a single day. Meaning I'm comfortable losing 20% of my trading account in a single day because I'm risking 10%. Right? If you're not comfortable losing that, you can say, after one stop loss a day, I'm going to stop trading for that day. Now, why is this so important? Why is this part of your risk management plan? Once you go over fund your $100, your $1,000, your $10,000, or you just got your profit, right? You're risking a certain percentage, right? You can go over, start risking 10% and lose the whole profit in just a single day, right? You can go over, take more trades, right? Take 5 trades and your account is gone. Why? Because you don't have a daily loss limit or a weekly loss limit. But if I have a weekly loss limit or a daily loss limit, I can go over and then say, after 2 stop loss, I'm going to pack my things and stop for that day. And it's going to help you retain your account. Man, me personally, I do go for 2 stop loss a day, 2 SL a day, and 4 SL a week. After losing 2 trades, first trade hits stop loss, second trade hits stop loss, I'm going to stop for that day, right? Come back the next day. Then, if I hit 4 stop loss consistently in a week, first trade stop loss, second trade stop loss, third trade, fourth trade, I'm going to stop for that week, right? Come back the next trade. This is going to help me know worst case scenario. In trading, we have losing streak, right? This is going to help you maintain and then still healthy in a losing streak. You won't end up bruising your account, losing your account, blowing your investors' accounts every single time. Why? Because you have a loss limit a week. So worst case scenario a week now, I will lose 40%. And before I blow my account, risking 10%, it's going to take more than 2 weeks. Right? Just like that. If you're risking less, maybe 5%, it's going to take more. If you're risking less, maybe 3%, it's going to take more. Meaning in a single month, you might not be able to blow that account. Why? Because you are risking less percentage and you have your loss limit. Now, this is going to help you end every single week in profit, right? And it's going to help you know worst case scenario, what can happen in a week. Now, the fourth thing, which this is what's actually going to keep you and help you end every single week in profit, is your number of trades. Now, if you don't have a certain number of trades you are taking per day or per week, it's going to just be terrible, right? You can make profits today and lose the whole profit to the market that same day, right? It's very, very possible. So if you have a certain number of trades, you can say, after 1 take profit, I'm done for that day, or just 1 trade a day, I'm done, or 3 trades a week, I'm done. And this is also going to help you to be selective. With this, you won't go and start jumping on random trades. You wait for your criteria to be complete, right? You wait for your confirmation to be present before you go and jump on that very trade, right? Why? Because you have a number of trades. And another thing, once you go over, take your first trade. Me personally, I do go with 3 trades per day, maximum of 3 trades. So I don't take anything more than 3 trades in a single day. Now, why is this? And how do you go about this? Once you take your first trade, and that first trade went well, right? You take profit 1:3, 1:4, 1:5, arrow, your risk to reward ratio, right? You make profit. You're gonna try again, try taking another trade. Now, if you are selective, if you know, okay, I won't exceed 3 trades today, so I have to be selective. I won't just jump on some random trades. Because if I jump on some random trades, I might end up exceeding my trades, which I don't want to do. So if you go over, you're gonna stay selective. You won't go over, take all random trade. Your setup will be present, and once the setup is present on the second trade, you take the trade. That trade went against you. You hit stop loss. You've just lost some percentage of the profit you made. Maybe you're risking your normal $100. Now you hit stop loss. From the $300 profit you made, you lost $100. You still have about $200 left on your profit that for that very day. And if you go over, try the third trade, and that trade goes against you, that hits your stop loss. You've just lost almost over half of the profit. You are now left with about $100 profit on that very account on that very day. Now, if you go over, take the fourth trade, you've just exceeded, and it just means you didn't make any profit that very day. But if you have a certain number of trades, you're gonna know I'm meant to stop after taking those 3 trades. I'm done. I've exceeded my number of trades, then I'm meant to stop. I'm meant to come back again. And if you stop, you're gonna end that very day in $100 profit. You're gonna end it in about 1 arrow profit that very day. The next day, you can try again with the profit you made. Just like that. You have a number of trades. You don't have to exceed it, because you can go over, lose the whole profit back to the market. And this is going to help you end every single week in profit, right? Because you are now keeping the profit you made and not losing everything back to the market once it goes against you. Then the very last thing, right? The very last thing, and one of the most important things that's going to help you become successful and become profitable in trading is you want to learn to compound, right? This is compounding. Now, every trader's dream is to fund an account. I said this earlier. Fund an account, trade that very account, and see how big that account is gonna get, and start placing withdrawals. Start withdrawing, start enjoying money from trading, right? Or get a prop firm, pass the phase 1, pass phase 2, and start receiving payouts. Now, it's not gonna be possible if you try flipping that account, right? It's not gonna be possible if you try gambling on that very account. It's gonna be possible when you learn to compound and grow that account conservatively. Now, how is that possible? With these 4 steps, right? With these 4 steps I've just given you on how to create a solid risk management plan, you're gonna watch this closely. That if you fund any account, you fund about $1,000, and you are risking 10%, which is about $100 on a single trade. And for every single take profit, it's gonna be plus $300. And for every single stop loss, it's gonna be minus $100. And with what I've taught you now, I believe you now know how to calculate your risk and then know how to pick how much you're risking on a single trade. Now, you want to go over, let's say, 2SL or 4SL, 2SL a day or 4SL a week, and 3 trades per day. Now, you can go over, let's say, with this, I can draft out a plan. And let's say for this very week, I'm going to try 5 or 6 opportunity. Let's say I'm going to try 6 trades, right? And for every single 6 trades, I'm going to be risking $100 on a single trade. And if I reach $100 on a single trade now, and I'm going to make about $300 on each trade, meaning I'm targeting 1:3 RR, right? If you take 6 trades, and out of that 6 trades, 3 hits stop loss. 3 hitting stop loss now is going to be minus $300, meaning you are risking $100 on a single trade. Then if only 3 hits take profit, you are going to be left with plus $900 profit. Now, if you watch this closely, because of a risk to reward ratio, because you have a certain number of trades you are taking in a day or a week, and also a certain number of losses, this can be very possible. Now, this number of trades, like I told you, is also going to help you become selective. You won't take all random trades. Now, if you watch, that very day, that very week, you're going to end it in about, your account will now be at about $1,600. You've just made 6 RR on that very account. You just made 60% on that very account. If you're risking 5% right on a single trade, you just made 30% on that very account. If you're risking 1%, you just made 3% on that very profit. And you were able to do this not because you won many trades, right? You didn't win so many trades. You only won half of the trade you took. You took 6 trades, you won just 3, and you can see you still end that very week in profit. Even if you do this 6 trades and you lost 4, and you won just 2, you can still end that very week in profit, but it will be a little profit. Why? Because that week you had more losses than wins, but you still ended that week in profit. Why? Because your risk management plan is solid, right? And this is what's going to help you. And if you're able to end every single week in profit, trust me, you are on your way to become a profitable trader. You are on your way to start bagging crazy profit from the market every single time, right? So these are my steps on how to create a solid risk management plan. It's not always every time about the charts, every time about technical analysis, right? Sometimes this is what it takes, right, for you to actually become profitable. And I want this video to break the internet, right? Share it with your friends so you can go over and watch this, understand what I've taught right here. And if this video was helpful, subscribe and drop it in the comment section how you think about the video, right? Or what you think about the video. And also, if you want to learn trading directly from me, I have a mentorship class where I teach students how to trade, right? You can click on the link in the description to join my mentorship class. So without further ado, I'll see you guys in the very next video. So take care, guys.